So everything at the moment is currently leading towards a recession. So markets, we're most likely going to see a lot of volatility, but a lot of volatility to the downside potentially. And so what I would be doing in this scenario is basically just trying to hold on and save as much cash as you possibly can, because that will give you a lot of security. Obviously, even though obviously inflation is running really hot, it's better to have cash sitting on you, because it's obviously not going to go down with markets and that sort of thing. The other alternative is to hold on to gold as well. And typically in recession environments, there is defensive plays as well that you can invest into, which tend to do a lot better.
Yeah, we'll golden, baby girl, we'll golden. They're about to see us shine, 'cause we're golden. They can't ever break us down, 'cause we're golden.
Hey guys, just before we head into the episode, if you have been enjoying the podcast, please make sure you subscribe on whatever platform you're using, whether you're using Spotify, Apple, YouTube, whatever it is that you're using. Please make sure you hit the subscribe button. It really does help us out a lot. It obviously means more people will be able to see and trust our content. It also means that you'll get that content every week, and we really do appreciate all the support, all the shares, all the likes, all the comments, all the messages that we get. It does help us and spurs us on to keep providing more value and deliver quality content to you guys. So a massive thank you. Guys, I just want to say a massive shout out to the sponsors of the Early Investors podcast, SwiftX, Australia's most trusted crypto exchange. After using it for the nearly 3 months now, I can see why. The customer experience and the UX and the UI is so simple that it's so easy to use, which I think is massive when you're looking to get started in your crypto journey, and just even navigating quickly, because I know that's something that we're all trying to do when we're investing, being able to use it. The customer support's second to none. I think that's the thing that stood out for me is, I've been with other, crypto exchanges in the past, and the customer support just isn't there. And that's really difficult when you don't know what you're doing, or you don't know, how to navigate the app or how to do certain things. And that's really great. And they've got all the bells and whistles now. Staking is a big thing that I've used in the past that they have. And I just think all in all, it's been the best experience I've had in using a crypto exchange. So that's why we decided to partner with them. We did have other offers on the table. So if you're interested in signing up for an account, use the affiliate link in our bio. It obviously helps us grow the podcast as well, so we really appreciate that. But we wouldn't partner with companies that we don't trust. So when you do sign up through the affiliate link, you'll get $20 worth of free Bitcoin. So you get the party started. And a great way to get your journey in crypto started. So yeah, big shout out to those guys, and once again, thank you to you guys for all the support. Braydos, welcome back.
Thanks, mate. Thanks for having me.
It's a crazy time in the world at the moment, and obviously our hearts go out to everyone in Ukraine and Russia too, who don't want to be a part of this, and they're gonna go through a lot of pain as well. And it's a very sad time in the world. So as I said, our hearts go out to everybody there that's affected. We're going to do our best today to try to think about some of the financial ramifications. We're not going to talk too much about the politics and the geopolitics, although it does come into it at parts. That's not really what we're here to do. There's people much better suited to talk about that than us. We're just going to obviously talk about and try to offer, I guess, some value to our listeners of like, okay, what's the potentials here? What's going on, and what could potentially happen to the economy? Just before we get started, guys, as well, I just want to remind you guys, if you are enjoying the podcast, make sure you subscribe. Smash the subscribe button. It helps us out a lot. I always do this at the end of the podcast and never at the start, so the team remind me. So make sure you smash the subscribe button.
You can tell you've been on a podcast before this.
Yeah, I'm a bit rusty. Again, like we've obviously had conversations about this as well, and someone actually reached out to me last night and said, "Man, that the Row episode that we did, the crypto interview of the year, the two-part series, sorry." And they mentioned how we kind of talked about a war and a recession, and there's a lot of pain to come, and these kind of things. And she says, like, and I just found it so interesting how you guys looked at the past, you looked at that interview, and you kind of brought together the past and what it can start to help, or what it can do to help create some frameworks for the future as well. So I think that's what we're going to do today, right? Like, we're just going to talk about everything that's happening. We're going to talk about the different factors that are involved, and, you know, some of the key things that, you know, give us some frameworks on how to think about the future. Because, you know, what we experienced back in 2020 during COVID wasn't really a recession. Like, it was, but it was short-lived. It wasn't painful at all. You know, and I feel like we're probably going to feel the you know, this is kind of like the defect. You know, this is the kind of the downline defect that we're going to feel over the next quarter, 2 quarters, however long, you know, it is. We're not sure. But I guess, you know, where we start is, you know, obviously the situation in Russia and Ukraine, and obviously everything that's happening there. Obviously, Russia have invaded Ukraine, and, you know, there's obviously a lot of speculation around why. We'll obviously try to, I guess, paint some picture a little bit, you know, about it, but we're not going to go into detail. But, you know, there's sanctions involved now, and they're getting harsher and harsher by the day.
There's going to be a lot of repercussions for Russia and all of its citizens, unfortunately.
So what are some of those sanctions that they're...
So the biggest one is obviously them being taken off the SWIFT payment settlement network, which basically allows the Russian banks to exchange dollars and other forms of currency for trade. So Russia being the biggest exporter of wheat in the world, and also the 3rd largest supplier of oil as well. So, I mean, if we thought that there was going to be a lot of supply restraints because of COVID, we're going to start to see them ramp back up around the world. And, I mean, you can obviously see that the price of petrol is a lot higher, and we're going to start to see prices of food probably increase as well. Maybe not so much here in Australia and the US, but certainly around a lot of parts of around Europe for sure.
And Africa.
Africa as well, yeah. Even Asia to some extent too.
A lot of the emerging markets.
Yeah, definitely.
So I think that maybe I look at this in maybe 3 to 4 kind of, or there's 3 to 4 things that I want to cover today, main sections, and the first one is inflation. And obviously there's 2 types of inflation, or 2 things that bring inflation on. There's monetary supply, and then there's obviously supply and supply-led inflation. And obviously you talked about some of those things, you know, like wheat. You know, I'm pretty sure Ukraine and Russia are responsible for 25 to 30%
of the world
supply of wheat. Yeah, supply of wheat.
Exactly. And wheat's one of those commodities that you can't store for a long period of time as well. So you can only store them for, I think it's 5 weeks. So the world's reserve of wheat is only 5 weeks long, and there's not going to be a growing season in the Ukraine. So we're going to see a massive supply shortage of wheat around the world, and then obviously oil as well. And Russia being the 3rd largest, they supply a lot of their oil to China, and then also to the rest of the world, but mostly in Europe. And then they're also one of the biggest suppliers of natural gas as well. And so we're going to start to see, especially around Europe again, the price of gas, so heating and that sort of thing, just going through the roof. And so, this is going to have an effect, obviously, on inflation again. And we're already in an inflationary environment. You had COVID, which the government overreacted to. All central banks around the world, they just printed a lot of money, and they handed out all the stimulus checks to everybody because they were forced to stay at home. And so with that, you had a lot of the manufacturing industry just basically shut up shop because they were all locked down. And then when that sort of thing happens, it takes a long time for these sort of things to ramp back up again. And so we're seeing shipping costs just go through the roof, and that's why a lot of goods are a lot more expensive now. And so because of those inflationary pressures, we're seeing everything get more and more expensive. And now this is just exacerbated even further as well.
Yeah, and we're coming off the back of monetary inflation as well, you know, like more money than ever being put into the system.
40% of the US dollars were put into supply because of COVID.
Yeah, and I think that's the thing.
It's hard to wrap your head around that sort of figure.
Yeah, 100%. It's ridiculous. And then, you know, obviously you talked about supply, and now it's only going to get worse from here. You know what I mean? So I think, and you know, like I got an interesting point here that I've done a lot of study, so I've done my research. But it was interesting because I was listening to like Chamath and a few of those guys talk about it, and they're like, well, let's just go to solar. And like
Elon Musk has come out tweeting saying that we need to start ramping up production of energy, nuclear and even coal, which is obviously goes against his mandate, but he knows that what the repercussions are going to be of these supply shortages.
Yeah, and so one of the things that were mentioned, or that these guys didn't think about, but I listened to another brain in this space, and he was talking about the fact that copper is actually the most in demand or the biggest piece of infrastructure as it relates to the world, you know, and the reason that we can't accelerate towards EVs or, you know, not just EVs, but renewable energy is because of the fact that we don't have enough copper to do it as quickly as we can, which I thought was really interesting, which means that, you know, if you know, there's not an easy answer to this whole conundrum around the fact that, you know, obviously we're looking at wheat and food and what that does to Europe, but what it also does to places like Africa. You're then looking at, you know, obviously the things that you mentioned, gas, oil, and
so all commodities are going up across the board, and that is purely because of these supply shortages.
Yeah, and I guess I want to talk about and touch on like why that's a problem, right? Like, so obviously, you know, we have CPI and we have that as a metric, but then we also have, and then, you know, we're going to add, you know, these shortages on top of what we're currently looking at. And obviously that eats into people's money, you know, like I think when you think about the everyday person who has a fixed wage and, you know, the fact that, you know, wheat's fucking like, you know, food is going to get more expensive. Petrol, energy is going to get more expensive. You know, this is money coming out of these, you know, out of the wallets of the everyday person. You know, as you said, it's going to be different in different areas, of course. But, you know, if we're thinking about some of the areas that are most affected, you know, it's already tough. You know what I mean? It's like we're already in a high inflationary period. It's only going to get worse from here. We're not going to feel the effects of what's going on right now until April, you know, May. So,
unfortunately, the thing when it comes to inflation is it's a self-fulfilling sort of cycle. So you have all of these supply shortages which boost the costs of these the prices of these commodities. And so because the cost of these commodities goes up, those costs get passed on from the businesses down onto the consumer, us. So obviously it's more expensive to go and get petrol and all those sort of things. But in doing so, less and less people are demanding of those goods and services, and so less people are out there spending their money because they're simply just not able to afford it. Their wages aren't increasing, so then they demand more wages, and so the cost of the business continually goes up. So they're having costs from two sides now. They're having costs of labor, and they're having costs of actually purchasing these goods. And then that just gets passed on to the consumer again. And then, as I said, it's a self-fulfilling circle, and inflation will go through the moon. And so the reason why that is such a problem is because it, as we mentioned in the RAL investor podcast, it just reduces our purchasing power. And so when you have diminishing purchasing power, the best thing you can do in those scenarios is to save. And when you have people who save rather than spend, that slows down the economy. And so once you have a situation like that, that tends to be what is referred to as stagflation, where you have consumer prices going higher and you have a slowing economy as well. And these are not good things. This is what has been happening in Japan now for the past, since the 80s. So.
And they just announced yield curve control, didn't they?
They did. Yeah, yield curve control. And they've been doing it for a long time. Australia does it, or they did it during COVID. Next, we'll most likely see it happening in the US as well.
And so one of the big things at the moment which we're seeing, which is, you know, obviously the Great Resignation and people leaving their jobs, that kind of ties back into what you were talking about before, where, you know, the costs of the company due to the inflation obviously drives what drives wages up purely from a kind of cause and effect perspective.
Yep.
You know what I mean? So like obviously, it does have a and that's something that I started to learn when researching for this as well, is that it does have that kind of cause and effect type of relationship where
well, the cost of goods become more expensive, and so employees obviously, they're seeing that the company's profits are starting to get bigger and bigger, and so they want a piece of that pie as well. And because they're now unable to afford just your simple services such as food and petrol and these sort of things, they're demanding higher and higher wages. And as I said, that is just a self-fulfilling spiral, which just leads to hyperinflation, unfortunately.
Yeah. Well, I think that's the like obviously the wage squeeze is obviously off the back of that, but it also, like you said, it's a self-fulfilling prophecy. And then that kind of brings us to interest rates, which is obviously a really, something that's really, really interesting at the moment, because the Fed's come out and said that they're pricing in, 6 or 7 rate hikes over the next.
It was 9.
It was 9.
I think it got to, at the highest point, it got to 9. I think it's now reined back into, I think it's about 6 or 7 rate hikes. Because the role of the central bank is to take a handle on inflation and unemployment. So currently we have, around the world, we have really strong labour markets, so unemployment is falling. But now, obviously, we're seeing around the world, we've got inflation problems. And so that's their number one mission at the moment, is to try and combat inflation. But it's happening at a really interesting time when you've got the global economy starting to slow down. You've got all of these supply chain issues. You've now got war broke out in Europe. And so with these external factors, I mean, it's going to be really hard for them to start increasing rates, because typically increasing interest rates is looking within the economy and trying to fix the problems within the economy. But because this is an external factor, it's very unknown, and we're basically just going to see a long period of volatility now.
Yeah, and so, want to dive into that a bit, right? So the reason that we're already in a high inflation environment, and in a it's not necessarily just driven by monetary. It's not just driven by that. That was the start of it,
so
but
it's also fiscal as well. So that's the QE that's been happening around the world. So when you've got such loose monetary situation like that, you're just having more and more money injected into the market, and a lot of that money is put into bonds. And so this is where yield curve control comes into it, where the government can't afford for there not to be any buyers of their treasury debt. And so, and now we're seeing, obviously, with Russia and China, they're not holding on to those reserves anymore, because they're losing faith in the dollar, and they want to be out of the dollar standard. And so with that, because there's less demand for the government debt, essentially, where else are they going to get buyers from? And so the only person who's going to come in and buy them is the Fed. And so this is called yield curve control. Australia has been doing it, as I said. Japan's been doing it for decades now. The Eurozone has started implementing it too, and the Fed will be the last one. And so that will help to prop up this market. And this is where, this is why a lot of people on Twitter are starting to say that we've reached a point where it's forever money. It's forever QE. They're just going to continually print money, continually debase the currency.
Yeah. So like some of the situation we're in, right, is kind of like, like the Fed can't raise interest rates enough to actually put a dent in inflation.
No, because if they raise interest rates to the point where
we've seen a 0.25 increase, and the fucking market, it was 10% or something.
Yeah, I mean, they've just been talking about raising interest rates, and we've seen the whole NASDAQ market just basically collapse on itself. Yeah. And the S&P is within correction territory now, which is considered 10%. So, I mean, we haven't even raised rates, and we're already seeing markets sell off. And typically when markets sell off, you have higher rates of unemployment. So this is where it becomes really tricky for central banks around the world, is they're trying to rein in this inflation narrative. But by doing so, it causes the economy to slow down, and you see stocks and whatnot, and bonds also selling off, what that does, it increases unemployment rate, and then you've got this hurdle of which one do we actually need to worry about more, unemployment or inflation. Right now, obviously, they're trying to tackle inflation because it's the headlines everywhere. We're going to have a CPI print in the US, which will probably read 8% inflation. And so that's just mind-boggling. Like, everything's just gone up that much.
And it's not going to get better.
No, it's going to continue to get worse because of all of these issues around the world.
Yeah, and I guess that's kind of like the theory then, right? Is like they can't raise rates because inflation's going to run. You know, the sanctions.
They will. We've got a FOMC meeting this week, and they will raise the interest rate, and they're going to try and raise it up to about 2%. At first, they'll do it slowly, and then it'll all happen at once. But 2% is just about as high as they'll be able to get it without bankrupting the US. Because you have to remember, they've got about $1 trillion worth of interest payments every single year. If they raise rates from currently 0.25 up until 2%, that's what? That's what's that? It's about a 500% increase on the interest that the US will have to pay on their own debt to service. And then that doesn't even apply to corporate debt and to retail debt, so the mortgage market and all these sort of things. And so you can only imagine, as soon as that happens, liquidity in the market's just going to dry up. And as soon as that happens, they're going to have to print more money, and they're going to have to lower interest rates to the point where it's down to 0% again.
Yeah, and that's kind of what I mean, right? It kind of brings us back to like the pandemic or the start of the pandemic. It's kind of like...
Oh, this comes back to the video that we did on Real. Like, this goes back way back to...
Yeah, but it's kind of like the most
II.
recent situation that you can think of is like, you know, they'll raise rates, but, you know, how long for? Like, how long is it going to last? Because I just don't... You know, and that's the reality is like a lot of it's already priced in. You know what I mean? Like that's the thing. That's why the markets have been fucking horrific since October. You know, like it's just been trending sideways and so volatile.
Well, the last time they went on a rate increase was back in 2018. They got rates up to 2.75%, and the whole credit market started to crater, and stock market started to collapse as well. Before that was the GFC. They raised rates up to, I think it was 5.5%, and then you had the housing market just collapse on itself. And so who knows what's going to happen this time around with housing market at all-time highs. You've got equities at all-time highs. You've got commodities now at all-time highs. You've got inflation everywhere. Like...
Yeah,
it's a mess.
and I think
mess.
and I think that's kind of like the dynamic that we're trying to put across here is like understanding that, like especially in an inflationary time, like they can't fix inflation right now. Not with the sanctions that have been put on Russia. It's impossible to, because the supply shortages are only going to get worse. So the fact that inflation is going to run, and it's going to run anyway, means that it makes it really difficult for them.
The counter to that, though, is that because we've got all of these commodities going up, there's less demand for... people are probably filling up less at the petrol stations, so people are probably trying to hold on to or start saving again, I suppose. And so because of that, because there's no spending out in the economy, that will help to reduce inflation. So that is working in their favour. And I mean, everyone's heard it. They're going to try and inflate the debt away, and that's the only realistic option that they have.
Yeah, but you know, it's not going to be enough though. Like what they're doing, it's not going to be enough to combat that. You know, like
that's right. So inflation might. It's what they're going to have a reading of 8%. It might go up to 10% or something like that. And so even if they able to increase interest rates to 2%, you're still going to be earning a negative yield on nominal terms.
Yeah.
So
it's crazy.
Yeah.
And I guess that kind of sums up like the overall position. And you know, like I guess this is where some of that game theory comes in of like, you know, the next thing we're going to talk about is reserve currencies. So, you know, let's just cover the first two things and do like a little bit of an overview before we go into that, because I think the reserve currency thing is more of like we start to talk about some of the strategy behind maybe what's going on right now, and you know, some of that stuff. But, you know, you've got inflation. that was already running really hot because of supply shortages and more money than we've ever seen enter the system. We're now seeing sanctions on Russia, which are just going to cause more supply shortages, which means inflation is going to run even hotter. Inflation basically means buying power. The money you have now buys you less tomorrow.
Yep.
And that's because the prices of the assets and the goods that you buy go up. And then, on top of that, we've obviously got interest rates and the dynamic of the Fed trying to obviously fix the problems that are occurring right now. And they're saying they're going to raise interest rates, and they probably will a little bit. But in reality, if they were to do the 9 interest rate hikes, or they to the level that they claim they're going to, the economy would basically fall apart.
It's going to crater. Yeah.
It would crater. It would fall apart, and they can't afford to do that because you've got pensions and everything relying on that. So the reality is that the situation you find yourself in now is like they'll do it because they have to say they're going to do it, and they probably have to try to mitigate some of the things that are going to happen, but eventually you're probably going to have to drop the interest rate to zero, get the money printer going.
They will as soon as we... so everything at the moment is currently leading towards a recession. And so typically what happens in recession is your unemployment will go up, and so then they'll have to... they'll have to start doing yield curve control again, because a lot of those bonds will start to sell off. And they'll also probably have to start doing UBI, so universal basic income, because a lot of people will need to afford to live and these sort of things.
That's kind of what I was talking about when you talk about going pre-pandemic, or like not pre, but when the pandemic hit. That's kind of what we did. If everyone can remember, the government was putting money in your account, which...
Well, they already do it for, like with the family tax benefits and all those. That is a form of UBI here in Australia. There's similar things that are now being set up over in the US as well. I think that they've got them over in Europe too. So, yeah, we're going to start seeing more and more of this.
Yeah, and I was listening to something the other day, and they were kind of talking about every time, it was a cool stat, every time the price of energy has spiked 50%, US has gone into a recession.
Yep.
Every single time.
Yep.
And it's obviously to do with the speed of increase.
Yeah.
It's rapid. We were at negative energy prices, was it a year or two ago? Yeah,
well, it's when we were all locked down. There was no demand for energy, and so energy just, oil specifically, just went to, I think it was like $30 a barrel or something like that, and we're currently sitting at...
140.
Yeah, 140.
Fucking hell. That's ridiculous.
Crazy.
And so...
And on top of that, we haven't had wages increase anywhere near that amount. And so
exactly.
That's where the
they are
lies.
Increasing though, and that's because of the squeeze that comes from the side effect of all of these things we're talking about.
Yeah.
And that's kind of, I guess, why you see what it takes to keep an employee at the moment is super high.
Yeah.
Because it's
why businesses are struggling to find employees and all that sort of thing, because they're demanding more income.
Yeah.
But where's the additional money coming from for those businesses?
Not the economy.
No, it's not coming from the economy, because everyone's saving money as opposed to going out and spending it, because during uncertain times, people like to hold on to dollars. And so we're seeing it in the US now as well. The US dollar has been ranging so much higher. It's up 30% or something against some currencies. And so this then leads to another crisis where a lot of emerging economies that rely on their US dollar reserves are suddenly becoming uncompetitive. And so we're going to start to see a lot of recessions around the world in emerging markets as well.
And this kind of comes back, we've talked about this before, we really did talk about this in relation to, I think it might have been the Rao interview.
Yeah,
we talked about currencies and how obviously the fact that the US is the reserve global currency gives them the power to sanction, and it gives them a lot of this power. And obviously the amount of debt that they're going into, obviously it causes problems for a lot of other countries. And obviously because it is the global reserve currency, it kind of...
But not only that, because it also doesn't help the US, because as soon as the US dollar is strengthened, it makes exporting a lot harder for them as well.
Yeah, exactly.
And so here in Australia, we saw the same issue back in 2012 when iron ore was over $100.
Nobody wants to buy it.
Yeah. And it made it really hard for us to export goods because the Australian dollar was so high, and now we're starting to see the same thing happen to the US.
And it's because other countries are getting poorer at that same time, so they don't want to necessarily buy the exports that the US are offering.
That's right, exactly.
So let's talk reserve currency then. So I'm just going to read some notes that I've got here, but it's kind of like pockets of power, right? So the US has been the global reserve currency for a really long time. And in World War I, the British was the reserve currency, right? And the reason they lost, like that, and this is, I guess, the thing that, like back in the day, is you kind of think about what creates a shift in power in the universe. And previously it was gold, right? It's like you needed to have got a lot of gold reserves, and that allowed you to have, or I guess, the world to create enough trust in your currency being the global reserve currency. Previously, it was the British. In World War I, they lost a lot of their reserves. In World War II,
they lost, and the reason why they lost all their reserves is because they had to fund the war effort.
Yeah, exactly. Yeah, so they had to fund the war effort, and same thing with World War II. Basically lost it all. The US basically gained it all from the funding of the countries that needed to go to war, and then that obviously led to the start of the US power. You fast forward to today, and you almost find the US in a very similar position to what the British were, in that period of time.
That's right. The thing that is currently underpegging the US dollar as a reserve currency is the petrodollar system. And now we've just seen that Russia has been ultimately sanctioned and taken off that standard. And so now their unit of exchange for oil, particularly with China, is it's typically in euros, or it's even in ruble, which probably not anymore, considering that has just created, 50% or something like that. So another means of exchange could be gold. And so we're now seeing gold also rise in value as well. And so now, and even the US, they've recently conceded that there's going to be multiple reserve currencies in the world as opposed to just the US dollar. So we're going to start to see a lot more reserves in other currencies as opposed to the US dollar, which is a concern for the US because that's their biggest export is dollars. And that it also provides them with a lot of control as well.
Yeah, and I guess this brings us down to the game theory of all of this, right? And there's many different, speculations and, many different opinions and of Putin and why all this is happening and
getting into the geopolitics.
Yeah, I don't necessarily want to, but I think it's important to kind of give people an idea as to potentially why this is happening, and in reality, this is how the world works. It's power dynamics, Russia don't like being in the shadow of the US. No. The fact that the US can do what they do just by printing ridiculous amounts of money, putting sanctions on, and the fact that they have no gold reserves backing that anymore, I think that causes power dynamics. And, also, we're not dealing with 30-year-olds.
No. Yeah.
We're dealing with, people that are 90, these guys are old. They've come from, a time where war was just that was a thing. You know what I mean? Like we haven't experienced it, in our lifetime. Not to what they have.
No conscription sort of wars, yeah.
And you can tell Putin's like a 19th century man. But I think it's important to talk about some of the game theory around it, and potentially, there's three kind of things that I think are driving all of this, and I'm not saying one over the other or anything like that, but I think it's narrative, in terms of, I feel like Putin's a proud man, and there's narrative to it, like he doesn't, because I talked about it before, but it's like keeping the country safe, that real kind of nationship type of vibe around it, and the narrative of obviously the Russia's past, and there's a lot going on there. There's obviously the power dynamics of the global reserve currency. And, I think as well, one of the big things is obviously literally keeping the country safe. Like we talked about it before, and kind of I was listening to a guy, I forgot what his name is, a scientist at the University of Chicago. I think his name's Mearheimer, or something like that. But he kind of talked about in 2008, the leaders of NATO come out and said that they were going to welcome Georgia and Ukraine into NATO. And Putin said that would be a direct threat towards us. And you can kind of look at some of the things over time, like accumulating a ton of gold, holding little dollars, US dollars,
selling off their reserves,
selling off their reserves, developing digital systems, their own kind of railways of payment.
Well, they realized as soon as they went in and invaded Crimea, that as soon as that happened and there was threat of sanctions, that they had to do something about that, because they've got this theory that Putin has this big grand plan of basically reforming the Soviet Union. And so with that, they have prepared themselves to the point where they have dwindled their US reserves, they've built up their stockpile of gold, and they've started to also now trade with a lot of their partners in different currencies outside of the US dollar, and also even the euros to some extent as well. And so with that, it gives them a little bit of a cushion in regards to being able to take these certain actions that they're trying to do. But in saying that, I don't think that they quite realize that these sanctions were going to come in as swiftly as what they did, and really hard as well. And you can see that in that a lot of their reserves, which they do currently hold, they're all offshore, and they've now been frozen. So they had a $600 billion reserve pile, which has been frozen outside of the country. And so they can't now touch that money at all. They've been, a lot of the Western world has been going after all the oligarchs as well. And so all of Putin's inner circle have all been affected by this. And so they're sort of trying to basically dismantle his power that he's got within his own government. And we can see all the propaganda that they were doing within their own country as to why this Ukrainian war has now broken out. There was a lot of talks about Nazism and a lot of fascism and that sort of thing within the Ukraine. And so, I mean, it's such a mess, honestly. It really is.
I mean, it's really sad. It's really sad that this is where the world's gotten to. But I think if you go back and watch the interviews that we did, back then, it's inevitable.
It points to why this is all happening.
Yeah,
absolutely,
literally.
Because they've, like you said, they've lost a lot of their power. They've lost a lot of their I guess they've superpower. They've lost all that.
Yeah.
And so they're wanting to try and reclaim all that now while they can.
And the only way you can claim that is by getting off the US dollar. It's literally the only way. And that's why understanding that the only thing, the financial system and how all the countries integrate is basically the thing that controls the power dynamic of the world. And I think that's something that's interesting. Like in 2008, when the US expanded their balance sheet, Russia and China come out and started to call for a new global reserve currency. Over that time, you look at the moves they've made. Russia accumulating gold and doing all that, China going property and again kind of trying to get off the US dollar.
The Gold Road Initiative.
Yeah, you can just kind of see that there is a power dynamic here going on, and there's a few things here total payments around the world of USD dropped below 60% for the first time a few months ago, which was really interesting. And there's another argument to this, which I think it's important to kind of talk about. This is kind of what this guy from the University of Chicago is saying. He's saying basically if you control Ukraine, you can cripple Russia at any time, and if you can have troops there. And I kind of did think that this was a good point. It's and he mentioned that imagine China became allies with Canada, and they joined forces. That's a very similar kind of position as the US becoming allies with Ukraine and bringing them into NATO. Because what it means is that the US can then put troops in there. And if the US can put troops in there, they've then got a direct way into Russia. So there is a part there, and Putin did put this out in 2008. Doesn't mean that his actions are warranted. You know, he's a dictator. That's what he does. Like, it's literally what he is. So, but I just think, like, you look back at some of the history here, and it kind of does come back to this whole expanding the balance sheet, looking back at all the events since the 60s, and just going, this is always going to happen.
And his timing might be really critical here in that the US is in a vulnerable state.
Super vulnerable position.
Exactly.
They were just about to raise rates.
They're trying to unwind the balance sheet. There's less demand for the US dollar and their treasuries debt as well. And so, yeah, I definitely think that plays into the timing.
Yeah.
Absolutely.
100%. And I think it's like, but the biggest thing that we talk about now is like, how do you navigate this? Like, what's the, for us, what's the, we just went through and kind of put a lot of the things that we need to talk about on the plate and said that, these are kind of some of the scenarios. Obviously we're heading for a recession. Inflation's running hot. Everything we just mentioned, but like, what now? What does this mean? What does the next next 2 quarters look like? The next 6 to 12 months look like from a market's perspective?
So markets, we're most likely going to see a lot of volatility, but a lot of volatility to the downside potentially. And so what I would be doing in this scenario is basically just trying to hold on and save as much cash as you possibly can. Because that will give you a lot of security, obviously. Even though, obviously, inflation is running really hot, it's better to have cash sitting on you because it's obviously not going to go down with markets and that sort of thing.
Yeah.
The other alternative is to hold on to gold as well. And typically in recession environments, there is defensive plays as well that you can invest into, which tend to do a lot better. Or they tend to hold a lot more of their value compared to, say, growth, like as in tech and all these other things. So a lot of those would be utilities companies. So energy, obviously with oil and natural gases and those sort of things going higher. Could also be consumer staples, so groceries. Also healthcare, because people are always going to spend on healthcare. These are generally good places to have your money. But if you already do have money invested in growth and all that sort of thing, you just basically have to ask yourself, is it worth selling out now? You could potentially have a taxable event. Otherwise, it's better to just hold on and wait, because typically at the end of this, we're going to see massive QE. We're going to see interest rates go to zero again, and we're going to see a massive rally.
And that's kind of like, again, drawing back to the most recent pandemic and the start of that, and what you've seen there with like money coming into the system, house prices going bananas, stocks going bananas, crypto going bananas.
Yep.
But until then, I got the hiccups. Get ready to experience
a lot of volatility. So like, even if you're holding crypto, it's probably best to, like, the easy solution there is just to hold and potentially earn a yield on that money. Otherwise, if you're a little bit more advanced, you could trade these times because there's a lot of volatility. So if you've got any skill with TA, technical analysis, really good time to be making money. Otherwise, again, like I said, just hold cash, wait for there to be a bottom, or just dollar cost average your way in. You're going to get lower and lower prices. That's if you're able to save during these times as well.
Yeah, I just think like the main thing is, obviously this isn't financial advice, but we're going to experience a lot of pain in the next 2 quarters.
Even with real estate. So typically if we go into recession, there could potentially be a lot of volatility in real estate with rates rising as well. So your mortgage repayments are going to be higher. There's going to be less demand for housing as well. So we could see prices of housing start to decrease. So you could argue that housing is not the best place either. So yeah, there's not a lot of places, unfortunately. The best time would have been to put in all your money into oil about a month ago.
Yeah. But I think, I mean, and that's kind of like the goal. What the goal was of this was like to give you an understanding of what's going on in the economy with there's so much going on. Like, there was so much going on before Russia invaded Ukraine, and now that's happened. It's like, you don't know. We just don't know what's going to happen.
Exactly.
We don't know what they're thinking. That's one thing I want to say. We're not trying to predict and say Russia's going to do this, they're going to do this, blah, 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 blah.
They could sign an agreement tomorrow, and then we'll see stocks rally.
Russia could also invade fucking 6 other countries tomorrow.
That's right.
And we would, the whole thing would crumble.
God.
Right? And it's like,
It's crazy.
I hope that doesn't happen. It's very sad, but I just think it's important for the everyday person to actually start to understand what the current state of the economy is and what some of the potentials are.
Yeah.
Who knows what's going to happen? Nobody does. But to understand it is to mean that you can have some type of control over what you do and the decisions you make.
That's right.
Which I think is really important. So
exactly. Which is why at the moment, best place to probably have your money is in cash, because at least then you can be nimble and you can make quick decisions as soon as things, I don't know, something starts to turn around potentially, or, if things start to keep cratering and we enter bear market territory and all these sort of things, it's never a bad thing to hold on to some cash, because then you can invest it
100%.
once we reach a bottom potentially. So,
100%.
yeah.
Awesome. All right. Well, big episode, a lot to cover. As I said, I just think it's critical that we, people understand what's going on. Because even me, I'm just been researching. I did about 10 hours of research just to start to understand it myself. And as soon as you start to understand it, you go, wow, like,
can wrap your head around, you can make some sensible decisions.
Especially if you've already got investments, like starting to understand what's,
I'm sure you've been hit up all the time by what you should do with your portfolio and all that sort of thing at the moment. And
the answer is I don't know.
Yeah, well, that's right.
Like, I know what I can do because I know my position. And I think that's the most important thing. Know your position and know what you can do.
Yeah.
The decision's yours. It's not anyone else's to make.
And if you're stressed about all the volatility and your portfolio going down, you might have too much exposed, and so then that's why it might be best to have more cash sitting in your account, because then you're allowed to sleep at night, not having to stress about what's happening with your savings. So
100%. And I guess just one last thing is like for crypto's not exempt to this as people might think, right? Like crypto's not this big almighty power. I think we've seen now with Bitcoin. Bitcoin is still a victim to the tsunami that is the economy.
And there's been all these narratives about Bitcoin. It's an inflation hedge. It's a decentralized currency, so it can't be manipulated, all these sort of things. But currently, it's still a risk-on asset. It's paired in there with tech stocks and that sort of thing. So, yeah.
It still has those characteristics. It just doesn't have the trust.
It hasn't got the narrative.
Yeah, the narrative.
Hasn't got the narrative just yet. And so once the narrative starts to, like you and I know the narrative, but once it starts to flip in a lot of other people's minds, then we'll start to see the prices where we think it's going to go. But for right now, it's currently mixed in with other growth assets. And so that's why it's currently selling off. But,
who knows?
Yeah, who knows?
That's the reality.
It could decouple too.
Yeah, it could decouple. And that's the thing. I think the reality is nobody knows, right? And that's why everybody's got to understand their own position and their own situation and be able to make their own decisions. Yeah. Simple as that. Like there's, people can say that they do this, do that, or, anything, as we said, anything can happen.
That's right.
All right, guys. Big thanks for tuning in. Big thanks to the big Braydos coming down and sharing his wisdom. Marto, big thanks for putting this together, and as always to the listeners out there, big thanks to you guys. Thanks for the support. Really appreciate it. Thanks for tuning in every week. It's been great. Really hope you enjoyed the episode, guys. We'll see you next week.